It's been a two-day rout on Wall Street, and I think we're down, I don't know, what are we down, 7%, maybe 8 or 9 total at this point from the highs. So there are plenty of companies, though, that are in correction territory. And join us now, Jeff Mills, Chief Investment Officer at Bryn Mawr Trust and a CNBC contributor, and Stephanie Link continues with us. So in your view, Jeff, does this feel like a 10 to 12% garden variety correction for this, in this case, caused by coronavirus fears, or do you expect it to be more long-lasting and perhaps even more serious than that?
I mean, I think the truth is it's really hard to know. I talked to Andrew about this earlier in the month, but it seemed to me like the height of irrationality that the market wasn't pricing in any risk at all related to the coronavirus. So yes, right now we're within the confines of what would be considered a normal correction. So on any given year, about 12% would be a normal drawdown. So I think that's where we are now. If you're trying to be really tactical, though, I would say we're probably not quite at the bottom yet. So whether you're looking at the options market, put buying to call buying, doesn't quite look like capitulation yet. If you look at the percentage of stocks making new one-month lows, doesn't quite look like capitulation yet. And I think to assume that this is going to be contained might be going a bit too far. I mean, it's anecdotal, but Kyle Bass tweeted over the weekend, sort of an obvious China hawk, but he follows this stuff more than most people. There's a Chinese soccer team, flew out of Shanghai to Tokyo, then to LA, then to Brazil. No testing for the virus at all. Again, it's one example, but I think to assume we're going to see more headlines that shake the market in the near term, I think we have to assume that for now.
Yeah. I'm hoping, Stephanie, that there's still reason for hope. I mean, there are 1.4 billion people in China, and we're still under 100,000, aren't we, total infections? So it's not like it's just spreading like wildfire, right, and it's being contained. And if, you know, we've got, I don't know how many people in this country, but a lot, a couple 100 million, whatever it is, or more. So, I mean, they're containing it in China, but that's one thing, but then there's the economic effects, on the other hand, that could be, you know, multiple of how many people actually get it.
Yeah, that we just don't know, and social media is also not helping, right? It's
probably not great.
Probably not, but look, I think the setup was really poor, right? We were at all-time highs. Valuations are at 19, 20 times forward. Right. And we thought that this was contained, to your point. Now there's more questions. It's beyond China. It's going to be around a lot longer. And it's very hard to quantify from an earnings perspective what this is going to mean. What I'm trying to do is I'm trying to say, like, in 4, 6, 8 months, I think it will be contained. I think we will have more answers. And so I'm looking at companies that have been hit very, very hard. Not so much technology stocks, because they're still up on the year, guys, right? Some of them are still up 10, 15%. I'm looking at some of the companies like the cyclicals, like some of the consumer stocks, some of the companies that have gotten hit because like the travel-related names. And I'm thinking longer term, if you can get these stocks now at a good dividend yield, like a 3.5% yield, 4% would be ideal. That's actually what I'm doing. I'm picking away at those.
Okay. I think Jeff is too. Jeff, you noted that the move down has been led by growth, and that value stocks are already attractive and maybe even more attractive for a double whammy at this point. Is that how tactically investors should be looking at this?
I think that's the case. I mean, if you look at how the market's behaved since last Thursday, say, I think value's gained about 2% back on growth. And to Stephanie's point, if you look at names like Apple, like Microsoft, I mean, still trading 20, 30% above their long-term moving averages. So if you look for places within value, I think you can certainly find opportunities. I mean, I gave you guys a couple of names looking at D.R. Horton in the housing space, you know, a little bit more isolated in terms of geographic exposure, a play on now even materially lower interest rates. You can look even in places like energy. I mean, maybe you need to be patient, but a name like Cheniere, I mean, it has 80% of its volumes in long-term take-or-pay contracts. RBC values just those contracts at $66 a share. That's 25% above where the stock is trading today. So there are areas of the market and pockets where you can look. And I would definitely say that for now, if things start to deteriorate more, that growth momentum trade is no longer the safe haven that maybe it was a couple of weeks ago.